Did you know your pension could soon grow by up to 60% without you paying in a single extra pound? Yes, the government's just approved a major pension shake-up, and it could completely change how your retirement money grows. But here's the catch: not everyone will benefit. Stay tuned, because in the next few minutes, I'll explain exactly what's changing, who wins big, and what you need to do right now to make sure you don't miss out. Welcome to UK Insight, now your trusted guide for pensions, benefits, and senior living in the UK. Stay informed, stay supported, and enjoy your golden years with confidence. Subscribe now and join the community. For years, Britain's pension system has been criticised for being outdated and overly cautious. Huge sums of money, more than £2.50 trillion, are tied up in workplace and private pensions across the UK. But much of that money hasn't been working as hard as it could. Why? Because too often, pension funds have been invested in low-yield, ultra-safe assets, like government bonds, instead of high-growth sectors like technology, infrastructure, and green energy. In other words, while your money was sitting there safe, it wasn't really growing. Now, Labour's reform package aims to change all that. Under the new rules, pension providers will be encouraged, and in some cases, required to invest more of their funds in British businesses, startups, and growth sectors. The idea is simple: keep the money in the UK, fuel economic growth, and deliver higher returns for savers. But here's the big twist: these reforms aren't just about investing differently. They're about restructuring the entire pension market. Labour wants to merge smaller, less efficient pension schemes into larger, more powerful funds that can compete globally. Right now, the UK has thousands of tiny pension schemes, many with limited resources and high management costs. By consolidating these into a smaller number of super funds, the government believes it can unlock billions in savings, boost returns, and streamline operations. Think of it like this: instead of hundreds of little rowboats, each paddling in different directions, Labour wants one powerful ship heading toward the same goal: stronger pensions for everyone. Experts say this consolidation could help drive up returns significantly by as much as 60% over a working lifetime, simply because larger funds have more leverage, better investment access, and lower running costs. That's a game changer. Now, some people are calling this the biggest pension shake-up in a generation, and for good reason. Let's look at who stands to benefit most. First up, younger workers. If you're in your 20s, 30s, or even 40s, this could be huge for you. The earlier your money starts working harder, the more you'll benefit from compounding growth over time. Even a small boost in annual returns can translate into tens or even hundreds of thousands of extra pounds by the time you retire. But don't tune out if you're already retired or close to it, because the reforms could still affect you too. Many defined contribution pension holders, that's people whose retirement income depends on investment performance, could see better value and stronger annuity rates in the future. Plus, if these changes strengthen the overall pension market, it could mean more stable income options for current retirees and better protection against inflation. But, as always, there's another side to the story. Critics warn that investing more heavily in high-growth sectors like startups or infrastructure comes with more risk. Markets fluctuate, and returns aren't guaranteed. Some worry that pension funds could chase growth too aggressively, putting savers' money at risk if projects don't deliver. There's also concern about government influence, that encouraging pension funds to invest in UK growth might steer money toward political priorities instead of the best financial decisions. Labour insists that won't be the case. The government says independent trustees and regulators will continue to ensure decisions are made in savers' best interests, not political ones. Still, it's a fair question. Will these reforms genuinely make pensions safer and more rewarding, Or will they simply add more complexity to an already confusing system? Well, here's the reality. Right now, millions of pension savers are already losing out because of fragmentation and inefficiency. According to government data, some smaller pension schemes deliver up to 40% lower returns than the best performing ones simply because they lack the scale, expertise, and cost efficiency of larger funds. So, even if there's some risk involved, the potential upside of reforming the system is massive. And the timing couldn't be more critical. The UK is facing an aging population, rising life expectancy, and increasing pressure on the state pension. Without serious reform, millions could find themselves struggling in retirement even after a lifetime of saving. That's why this shake-up is so significant. It's not just about boosting returns, it's about building a pension system that's strong enough to sustain the next generation of retirees. But here's where you come in. If you're watching this video, you might be wondering, what should I do now? Well, the first step is to stay informed. Understand where your pension money is going. Check your latest statement. Most people have no idea which fund they're in or what kind of investments their pension provider makes. Take a few minutes to log into your provider's portal or call their support line. Ask questions like, what are my current annual returns? How much are my management fees? And is my pension invested in one of the newer consolidated funds Labour's reforms will affect? If your money is sitting in an older or underperforming scheme, it might be time to consider transferring, but always do this carefully, with proper advice. Financial experts recommend speaking to a regulated pension advisor before making any big decisions. A good advisor can help you understand whether you're likely to benefit from the new system or whether it's better to stay where you are for now. Remember, the goal isn't to chase quick gains. It's to build steady, long-term growth that will last throughout your retirement. Another key point to watch is how the reforms will affect auto-enrollment, the system that automatically adds you to a workplace pension. Labour plans to expand auto-enrollment to cover more workers, including younger people and those in part-time or lower-paid jobs. That could mean millions of new savers entering the system, helping to boost pension coverage and national savings rates. So even if you're not earning a huge salary, you'll still benefit from employer contributions and potential investment growth over time. And let's not forget the default funds, the investment options, where most auto-enrolled savers end up. Under the new framework, these default funds will be held to higher performance standards, with greater transparency on returns and fees. That means you'll have a clearer picture of how your money's performing and how your provider stacks up against competitors. Transparency, scale, and smarter investment, that's the core of this shake-up. But what could it actually mean in real numbers? Well, according to early projections, someone earning £35,000 a year and saving consistently under the new system could see their pension pot increase by up to £150,000 more by retirement compared to what they might have earned under the old rules. That's not small change. That's the difference between scraping by and retiring comfortably. Thanks for watching UK Insight Now. Don't forget to like, subscribe, and share with other seniors who need this info. See you in the next video. Stay well, stay informed.